Hi, can you hear me?
Hi, sir.
Hi.
So we are all set to go. We are live and shall we start?
Yes, please.
All right. Hello, everyone. Thank you so much for joining us this Monday evening for yet another seminar with Economics and Finance Association, BITS Pilani. It is with great honor that we welcome today Mr. Nilesh Shah, Managing Director. Just a second. Sorry, sir.
No problem.
It is with great honor that we welcome today Mr. Nilesh Shah, Managing Director, Kotak Mahindra AMC Limited. Mr. Shah is a prominent figure in the world of finance and investment. With a distinguished career spanning over 2 decades, he has established himself as a leading expert in the field of asset management and financial markets. Known for his insightful perspectives, strategic acumen, and a track record of successful leadership, Mr. Shah has played a pivotal role in shaping the financial landscape in India. His contributions to the industry, coupled with his commitment to financial literacy and investor education, have earned him a reputation as a thought leader in the field of financial markets.
Hello. Hello. Ah, ah.
Sorry for the disruption, sir.
No
Bit of a
problem.
technical glitch.
Yes.
So, as I was saying, today we will sneak a peek into the asset management industry of India and its various aspects, and of course, the Nilesh Shah special on lessons on investing from Mahabharata. Thank you and welcome, Mr. Shah.
Thank you, Ayushman. Good evening to everyone. Uh, if we look at our culture, our Sanskriti, we have always been told that money is not everything in life. पैसों के पीछे नहीं भागना चाहिए. My parents also told me the same thing. Connection issue. So that with his
Sir, I think
also told
there's
me
a
the same thing. Can you hear me now better?
yeah, you're audible, sir. Yeah.
Okay. So my parents also taught me the same thing. Don't run after money. But when I came to market, I liked a statement by Warren Buffett. Money is not everything in life. Money doesn't matter. But make sure that you have made enough money before you make such statement. I think in our culture, we respect both Saraswati Devi, which is knowledge and wisdom, and also Lakshmi Devi, which is money. So my first recommendation to students will be Please respect money. Obviously, money can't buy everything, but please remember that if you have money, you will be able to buy many things. The second then comes, how do we generate money? How do we get money? Many people work 24 by 7, 365 days a year to earn money, but they don't spend enough time on taking care of money, on ensuring that their savings actually become investment. Let me give you an example. 18 crore Indians have lost money in crypto trading. Now, out of 18 crore, probably 17.99 crore would not have understand what crypto meant, but they all went in because someone was advertising, someone was telling them to buy crypto. About 2 crore Indians have lost money in Ponzi schemes, from PSCL to City Limousine to Rose Valley. I mean, so many Ponzi schemes have continuously kept on coming in last 2, 3 decades and taking away investors' money. SEBI conducted a research. 90% of people trading in stock market in FNO lost money. I mean, 9 out of 10 people lost money and only 1 out of 10 made money. Why are people lining up to lose money, whereas they should be seriously interested in making money? I think this is where greed comes into play. People become inherently greedy and they want instant gratification. Please remember, there is no shortcut to success. There is no quick fire way to make money. Money is made through disciplined investment, through long term investment. Today, there is so much material available about how to make money, how to create wealth, how to be an investor like Warren Buffett. In fact, someone asked Mr. Warren Buffett that, sir, so much has been written about you. Is there any technique which you haven't taught outside world? Warren Buffett said, look, whatever I know, I have told people. There is no tarkib left with me. Then the next question came, then why is there is no another Warren Buffett? If people know how to make money reading your books, then why haven't they become like you? And Warren Buffett replied that, look, way of making money is a very slow way of making money. I made bulk of my money after 60 years of age, retirement
Sir,
age. People want instant gratification. They want T20 kind of play. They don't want to play test match and hence they don't make money. Why do people not do right thing and why do people do wrong thing? Well, could it be attributed to intelligence?
sir, your voice is cracking a bit in between. I think he's lost connection.
Is it better connection now?
Yes, sir, you're audible now.
Huh. So if you look at Sir Isaac Newton, he was 90% his time he discovered gravity. Now he lost bulk of his net worth in what is known as South Sea bubble. So there's no guarantee that intelligence will make you money. In fact, the state of Kerala, which is the most literate state in India, they spend on an annual basis more money in buying of lottery than what they have invested cumulative in equity mutual funds. The chances of winning in lottery are fairly minimal. The chances of losing money in equity mutual funds are fairly minimal on a longer term basis. And yet, literate Kerala buys more lottery than what they have cumulatively invested into equity mutual funds. So, intelligence has nothing to do with making money. It is all about how you play psychology, how you play common sense. Let me give you some example which shows common sense can make money for you. There was a legendary fund manager called Peter Lynch. He was equity fund man portfolio should outperform school kids' portfolio. The fund managers were furious. They wanted worthy competition, but Peter Lynch will have none of it. The fund managers under pressure opened their laptop and built a portfolio of high risk, high return stocks. The kids were under no compulsion. They were, not there for competition. They were there for fun. They picked up companies which they were using on a regular basis. Some toy company, some food company, some clothing company, some toys company. After 1 year, the kids' portfolio outperformed professional fund managers' portfolio by a margin. Peter Lynch proved to its fund manager that investment is all about common sense rather than Excel sheets. Despite knowing that investment is all about common sense, despite having so much literature which makes investment simplified, despite seeing that 100 Sensex is today 66,000, more than 660 times up in about 4 decades, why do people still lose money in equity? Why do people still go after cryptos, Ponzi's, and gaming kind of assets? Well, it's all about becoming rich overnight. It's all about controlling your greed. It's all about, relying on tips rather than doing your own research. Why does this happen? Well, in Mahabharata, there is a couplet which explains this beautifully. Before the beginning of the war, Krishna Bhagavan goes to Duryodhan and says, "Why are you fighting this unnecessary war? Please give it up. Just give 5 villages to Pandavas and they will not go to war." Duryodhan does not agree to it. Over a period of time, Duryodhan keeps on negating everything Krishna proposes. And finally, Duryodhan tells Krishna, "Janami dharmam, nachme pravrutti, janami adharmam, nachme nivrutti." Oh, great Krishna, please don't tell me what is wrong. I know exactly what is adharma, but I cannot live it. And please don't teach me what is right. I know what is dharma, but I can't follow it. In all of us, a Duryodhan lives. It does not allow us to become long-term investor. It does not allow us to become regular investor. It does not allow us to buy quality shares on a longer term basis because it pushes us to trade, it pushes us to rely on tips, it pushes us towards kachra stock with the hope of instant gratification. So always remember to control your Duryodhan, which will not allow you to walk on the right path. What is the right path? What is the way to make money? Well, there is no risk. There is no return without risk. Risk and return goes hand in hand. Equity is one of the most riskiest asset class, and hence it has potential to deliver the highest return. You cannot expect return in equity unless until you are willing to take the risk of volatility. But the longer your horizon goes, you will be in a position to reduce volatility and make money. What is the best way to invest in stocks directly? Well, you have to do research. You have no option but to understand company, their fundamentals, their management, and their financials. Combination of management, company, business will give you ability to buy stocks and more importantly hold on when the prices come down or when bad news comes. Please remember, there's no steady line in equity market. Prices will go up as well as down, and you need to average so that you can buy more when prices are attractive. That conviction to buy will come only if you have done your own research, your own analysis. Now, many people feel we don't have time, we don't have aptitude, we don't have knowledge to be a direct investor. Don't worry, there is mutual fund. There are more than 500 mutual fund schemes in India. If you do SIP in some of those schemes, some of those well managed schemes, your returns in the past could have been between 12% to 25%. That's a seriously good compounding. A regular investment, a SIP in equity mutual fund, over a period of time has ability to provide you financial security. Obviously, one will have to invest on a longer term basis. There's no shortcut to success. And even in a simple product like SIP, there is Agni Pariksha. In March 20, my SIP returns had become negative for last 3 years. 5-year SIP returns were lower than savings bank account. 10-year SIP returns were lower than bank FD returns. But if you withstand that Agni Pariksha, today you are enjoying double-digit SIP returns on your portfolio for last 3, 5, 10, 15, 20 years. That's a serious compounding. So you do have to withstand volatility. You do have to withstand ups and downs. But if you stay invested for a longer term, you will benefit. There are many investors which says that why not we put all money in equity mutual fund and we'll make maximum return. Well, you also have to understand your risk profile. I've seen many people who are very courageous when equity markets are going up and who become panicky when equity market starts coming down. In equity market, both days will come up as well as down. If you can't withstand down, then it is not possible for you to invest in equity. And which is where we recommend people to follow a disciplined asset allocation. There is need to diversify your portfolio across debt, equity, gold, real estate, and foreign assets. And then, as a portfolio, as long as it delivers better return than inflation, you are home. Focus on getting real return. Focus on getting return which is more than inflation on entire portfolio. There are many people who want to focus only on getting 100 beggars. Let me share you an incident which Ramesh Damani talked about. There are 3 legendary investors in India, Ramesh Damani, Nimesh Bhai, Radhakishan Damani. And Ramesh Damani would have discovered maximum 100 beggars. That means in his portfolio, he has stocks which are more than 100 times up. And yet his net worth is lower compared to Radhakishan Damani or Nimesh Bhai. And the reason is very simple. When 100 beggars came to Nimesh Bhai or Radhakishan ji, they loaded it up. They put huge quantity of money in those opportunities. When 100 beggars came to Ramesh Damani, he put in small sums of money. Obviously, it is the allocation which delivers you return rather than how much 100 beggars you have got in your portfolio, which is where asset allocation becomes critical. When to buy equity, when to book profit is as important as what to buy in equity. Now, many people say, look, asset allocation is such a complicated stuff. Why don't fund managers practice what they're preaching? Yes, we have a fund called Kotak Multi-Asset Allocator Fund. This we had launched very recently. But before that, for almost 17 years, we have been running what is known as Kotak Multi-Asset Allocator Fund of Fund. In those 17 years, the NAV is up about 17 times. It's about 16% compounded return by investing in a portfolio of debt, equity, and gold. So there are products which are available for you to invest if you don't have time and energy to invest directly into stock. By becoming a regular investment through SIP in equity mutual funds, by becoming long-term investors, and by becoming a disciplined asset allocator, I think all of you can get the financial security which you want, which you deserve. Indian mutual fund industry is at the cusp of fast growth. We have for 3 decades delivered good return to our investors. 99% of our investors will be happy. Very few investors will be unhappy. This has created 4 crore happy investors for us, and we believe the potential is 40 crore. Industry will continue to grow over a period of time as we expand our reach into semi-urban and rural area, as we expand from top of the pyramid to middle and bottom of the pyramid. And I am quite sure that mutual fund industry will continue to grow side by side and much faster than other industries like insurance and banking system. Uh, India is at a fantastic stage. It is truly our Amrit Kal. Our economy is one of the fastest growing major economy in the world. From 10th largest economy in 2014, we have become 5th largest. We will become 3rd largest over next couple of years, and then we'll continue to narrow the gap with Chinese and American competitors.
I think there's a connection issue, sir, again.
India.
Yeah.
Give me a minute. I think there is a patch where connectivity is little bit poor. It should come back in some time.
Yeah, now it is audible, sir. It was
Now it
there
is
for a
better.
second.
Yeah,
Yes, sir.
sure. So, unlike China, where GDP growth is not converting into profitability for corporate world, in India, GDP growth is getting converted into corporate profitability. About 4% of GDP on an average is corporate profit. If GDP goes from $3.7 trillion to $37 trillion over a period of time, you can imagine that profit for corporate India also will grow in similar proportion. As profit growth continues, market cap will continue to rise. There are three things which India offers: 3G of growth, governance, and green. Our earnings growth will be superior to the rest of the world. Our GDP growth will be superior to our peers. And this growth is the primary driver why investors are coming to invest in India. Second is governance. Our corporate governance standards are reasonably superior to our peer group and comparable to developed world. Obviously, it's a journey and we have to continue to improve our governance standards. But compared to many of our peers, we are in a far better situation. Put together growth and governance, it becomes a very, very attractive combination for global investors. The third part of India, which is not marketed enough, is green. India is the lowest per capita carbon emitter in the world. Our growth is reasonably green compared to the rest of the world. India has lower number of diesel trains than America. India will have more metro train network in kilometers than America in few years. By retaining green transformation of our economy, India provides a huge attractive combination to global investors in the form of 3G of growth, governance, and green. As India grows, investors' money will grow, investors' wealth will accrue. And Indian mutual fund industry will be a very, very important part of it. I request all of you to focus on your financial wealth as much as you focus on earning financial income. By becoming a regular investor, long-term investor, and disciplined investors, your financial security will accrue, your financial security will come through. With this, I'll open up for questions.
Thank you very much. Thank you very much, sir, for an insightful discussion. I think the path for students is now clear that we need to be patient and we need to be disciplined in our investments. And this is, I think, what most of our youth lacks right now. As for questions, we have a few questions from our audience. First question being, what traits young people need to develop in themselves to become ready for future leadership opportunities?
So there are two things which are required for leader. One is IQ, second is EQ. IQ is knowledge and wisdom better than are peers. If you have knowledge that's not sufficient, you also need wisdom. When to apply that knowledge, how to apply that knowledge. Every leader will have above average IQ. But over a period of time, IQ alone is not good enough to be a leader. IQ can give you a head start of getting noticed among your peers. But it is the EQ which creates sustainable leaders. EQ is about working as a team and making 1 plus 1 11 rather than 2. The team becomes force multiplier. If you are highly intelligent and you decide to do everything by yourself or by shaming your team members to your high standard, you are unlikely to be a good leader. What you need is EQ. EQ about delegating, EQ about giving guidance and support, EQ about picking up when things fail, taking the blame for failure and sharing the success, sharing the credit for success will be the best EQ for a leader. Leader with better IQ and EQ will be a sustainable leader, will be rising to the top. So if you want to be a leader, undoubtedly you need above average IQ, but also you need above average EQ.
That's very well said. Very well said, sir. I think most of the listeners will take this into account from now. We have another question, sir. So, can you throw some light on the company's investment philosophy and how it has been affected by the recent conflicts between Russia, Ukraine, and Israel, Palestine?
So our investment philosophy is very simple. I tell my team buy good companies run by good managers at good prices. मेरे लिए बोलना बहुत सिंपल है, उनको इम्प्लीमेंट करने में जान निकल जाएगा. But what do we mean by good business, good manager, good price? It's a good business is one which generates more return on equity than cost of capital. There are businesses where cost of capital is 12% and ROE of business is 8%. One day the company will go bankrupt. Where cost of capital is 10%, ROE is 16%.
I'm sorry, there is again an in the connection issue, sir. Your voice is cracking. I think you are audible
Can
again,
you
sir.
hear me?
Yes, sir.
Can you hear me? Yeah. So ROE better than cost of capital is most important for a business. And we are talking about sustainable ROEs, not 1 year ups and down. The second thing is management. A management which has a vision to do something, to achieve something, and which is willing to spend hours in execution to get it done, and which respects governance and which will not cheat you. Combination of growth, combination of vision, execution, and minority shareholders protection will be the driver for the management. And finally, you don't want to overpay for a commodity, for a stock. uh, you want something which is available at reasonable price. So if you can buy it at a reasonable price, nothing like it. So we are looking to buy good businesses run by good managers, available at good prices, good valuation.
Thank you so much, sir. I think that will provide a great insight to most of our listeners who are investing in stock market right now. Also, sir, we would like to know about your journey from being a CA to becoming the MD of a Kotak, to becoming the MD of Kotak Mahindra. If you could throw some light on that.
So when I joined, I cleared my CA and I joined ICICI. I was gold medalist CS, so I had little bit of ego in my head. And on day one, I saw far more intelligent people than me who were far more humble than me. So that was lesson number one. Be always humble. Don't try to show your arrogance to anyone. Uh, I worked with some of the giants at ICICI, and they have been my mentor even today. When I get confused on markets, economy, life, I go out to them. So please build a circle of mentor who will always guide you to the right path. When I joined Franklin Templeton post ICICI, I got to learn the basics of mutual fund. They always said client first. Don't focus on short-term success of business. Focus on long-term retention of customer. If client makes money, you will make money. In a very simple way, they said, Kar bhala to ho bhala. I was very successful fixed income fund manager, and between 97 to '03, my funds were delivering better return than equity funds. Money was flowing in. And then I realized that people are investing looking at past return, but the future scenario is looking very gloom. I went to my boss and said that we should return money to investors because they are not going to make money in fixed income. My boss was fully supportive of my idea, and he said, fair enough, if you think that's the future scenario, let's go ahead and communicate to investors. My 6,000 crore fixed income fund became 200 crore over a period of time. We returned more than 90% of money to investors. Now, that kind of thing builds your goodwill. That kind of things build your brand. You have to really put client first. So for me, the journey in mutual fund happened because I always kept client first. I never predicted market because that was not in my control, my hand. We were humble. We were having good support of our mentor, and we were also supported by a very good team. I always had the pleasure of working with the best and brightest minds in the industry. They were more knowledgeable than me, they were more smart than me. And I worked with them to create a team which will make 1 plus 1 11. So, this is the journey. Be humble, build a network of mentors who will guide you, always have team members who are smarter than you, and always keep client first. Never shortchange a customer. If client makes money, you will make money.
That is an inspiring journey, sir. I'm sure all our listeners today will learn a lot of things from your journey and apply it in their lives to reach the pinnacle. So, sir, you have been working in financial markets for over 25 years now. For all our young investors and listeners who want to break into financial world, can you describe what life has been like in that field?
Well, it's a tough life. Undoubtedly, there is a huge burden of expectations. People want to make money, and when you lose money, you don't get sleep in the night. You have to deliver to the people's expectations. And this is where, working in financial industry puts pressure. You have to deliver to the investors' expectation. Uh, Many a times process is in your hand, outcome is not in your hand. You really don't know what will be the outcome. So you have to keep client first, focus on the process, and let the outcome be in the hands of God. The returns are coming to you not because you are smart, but because your process is right. So if you focus on process, outcomes will flow. And you have to communicate that with the customers. I am not God. In my control, there is process. I will put my blood and sweat into that. And I will not take shortcut. I will not shortchange. I'll make mistakes undoubtedly, but I will still deliver based on the process.
I think all our listeners will now have an idea of what kind of life they will be expecting if they get into finance. Uh, Sir, one thing I personally would like to ask as well. How do you stay up to date on the latest market trends and developments? Am I audible, sir?
You are audible, Ayush, but unfortunately, we'll have to cut the call here. I'm going into a basement where the connections will be poor. We have a Kotak family wedding, and I'm reaching the wedding venue.
All right, sir. It has been a great talk
So
and discussion
I'm
with you.
sorry for cutting it little prematurely. But today traffic was good, and hence I reached my venue early. But thank you for giving me an opportunity, and I look forward to participating in future.
It's been an honor, sir, talking to you and discussing the investment philosophies and everything. Thank you so much for the talk, sir. Thank you very much.
Okay.